Before the crash comes, the wealthy do one thing that almost nobody else does. They stop asking, what should I buy? And they start asking, what do I need to protect? That's it. That's the whole secret. And I'm going to spend the next 30 minutes proving it to you with real, practical steps you can actually use. Not theory, not textbook nonsense, but the exact thinking that separates people who come out of a downturn richer from people who come out of it broke. I've been doing this for over 4 decades. I've made a fortune, I've lost a fortune, and I've made it back bigger. I've sat in rooms with people who moved markets with a single phone call. And I've also watched regular, hardworking, smart people get wiped out again and again, not because they were dumb, but because they were following advice that sounds smart in good times and gets you destroyed in bad ones. A downturn is coming. I don't know exactly when. Nobody does. And if someone tells you they know the exact month, walk away from them immediately because they're either lying to you or lying to themselves. But I do know this. The people who come out of the next downturn richer are already positioning themselves right now, quietly, calmly, while everyone else is still partying like the good times never end. Today, I'm going to show you exactly what they're doing differently, step by step, so you can start doing it too. Now, before I go any further, I need you to do something for me. This information took me 30 years and a lot of expensive, humbling mistakes to learn. You're about to get all of it for free, but only if you stay to the end, because I'm going to build on each point. And if you leave halfway through, you're going to walk away with half a strategy. And in this business, half a strategy is honestly more dangerous than no strategy at all. So hit subscribe right now. Before you forget, it costs you nothing, and make sure this actually shows up in your feed. Instead of getting buried by some algorithm that doesn't care whether you build wealth or not, do that now. Then keep watching, because it only gets more useful from here. Here's the first thing I want you to understand, and it's the one thing that took me the longest to really get through my thick skull, even after years of doing this professionally. Markets don't crash because stocks are expensive. They crash because money gets tight. I know that sounds strange because every finance show on television will tell you to watch earnings, watch the news, and watch what some CEO said on a call last Tuesday. I'm telling you, ignore most of that noise. What you actually want to see is how easy or how hard it is to borrow money in the system. When banks are lending freely, when credit is cheap, when there's a river of cash flowing through the economy, looking for somewhere to go, stocks can look expensive for years and keep climbing anyway, because there's always more fuel to throw on the fire. But the moment that river starts to dry up, the moment borrowing gets harder and more expensive, it doesn't matter how great a company's earnings are. The tide goes out, and it takes almost everything down with it, good companies included, sometimes even the good companies first, because they're the ones people sell to raise cash. I learned this the hard way early in my career. I found a company I thought was absolutely bulletproof. The numbers were fantastic. The story made sense. Everything checked out on paper. And I got run over anyway, not because I was wrong about the company, but because the entire market was starved for cash, and nothing could hold its ground, no matter how good it looked. That lesson cost me real money, and I never forgot it. And honestly, I'm grateful it happened relatively early, because it forced me to build the right habits before the stakes got even bigger. A lot of investors never learn this lesson until it's genuinely too late, until it's their retirement account taking the hit instead of some money they could afford to lose. So here's your homework, and it's simpler than it sounds. I promise you don't need an economics degree for this. Pay attention to what the central bank is doing with interest rates, and pay attention to whether banks and lenders are loosening up or tightening their belts. You don't need to predict the future. When rates are being cut and money is flowing easily, that's typically a friendlier environment for risk-taking. When rates are climbing fast and lending standards are getting stricter and stricter, that's your warning bell, and you should be listening to it. The wealthy don't wait for the news anchor to officially announce a recession. By the time that headline hits your television, the smart money already repositioned months earlier, sometimes almost a full year earlier. They're watching the plumbing underneath the financial system, not the shiny headlines sitting on top of it. Start doing the same, even in a small way, checking in on this once a month instead of obsessing over daily stock prices. and you'll be miles ahead of 90% of people holding a brokerage account and just hoping for the best. And here's something else worth knowing, because it trips people up constantly. Tight money doesn't announce itself with a siren. It shows up quietly in things like smaller companies suddenly struggling to get loans, in banks tightening up who they'll approve for a mortgage, in credit card companies lowering limits instead of raising them. None of that makes the evening news, but all of it is telling you something important if you're paying attention. By the time it's obvious enough for a headline, you're usually already late to react. That's not meant to scare you. It's meant to hand you an edge, because almost nobody else watching this is checking for those quiet signals. The second thing, and this one is going to sound like it contradicts everything you've been taught your whole life, but hear me out before you disagree. Owning 50 different stocks does not protect you the way most people think it does. I know. Diversification is the golden rule that gets repeated in every single beginner's guide to investing. And listen, for a regular person just starting out with modest savings, some diversification absolutely makes sense. I am not telling you to go bet your entire life savings on one single stock. That would be reckless, and I'd never encourage it. But here's what nobody explains properly, and it's the part that actually matters. Real wealth isn't usually built by owning a tiny slice of everything under the sun. It's built by understanding a small number of things extremely well and being willing to put real weight behind those convictions when the setup is genuinely right, and then having the discipline to walk away completely the moment it isn't right anymore. The wealthy aren't spreading themselves thin across 40 average, half-researched ideas they barely understand. They're doing deep, serious homework on a handful of businesses or sectors, really understanding the story behind the numbers, not just the ticker symbol, and then sizing their bets according to how confident they genuinely are, not according to some rigid formula in a textbook that treats every idea the same. And just as important as knowing what to own is knowing when to own nothing at all, which is a lesson that took me years to actually respect. Cash is not a wasted position sitting there doing nothing. Cash is a decision, and it's often the most powerful decision available to you. Sitting in cash while everyone around you is chasing the last leg of a rally isn't fear, and it isn't laziness, it's patience. And patience is one of the most underrated tools in this entire business. Maybe the most underrated tool of all. I've had stretches where I held far more cash than felt comfortable, where I honestly looked overly cautious, maybe even a little foolish, to people watching from the outside who thought I was missing out. And then the downturn hit. And that same cash let me buy incredible businesses for pennies on the dollar while everyone else was being forced to sell just to cover their bills and their margin calls. Before a downturn, especially, ask yourself honestly, if the market dropped 40% tomorrow morning, would you be a buyer? Excited and ready? Or would you be praying and checking your phone every 5 minutes? If the honest answer is praying, you need more cash sitting on the sidelines and fewer scattered, half-researched positions cluttering up your account, not more of them. I want to be clear about something, because people twist this into an excuse to do nothing. Holding cash isn't about sitting on the sidelines forever, waiting for some perfect mythical bottom that never actually arrives. It's about having ammunition available when the odds finally tilt heavily in your favor. Most people run out of money to invest right when things get cheap, because they were fully invested the entire way down. The wealthy make sure that never happens to them. They'd rather miss a little of the upside on the way up than be completely powerless on the way down. Third point, and this is one people really don't want to hear because it feels a little bit like admitting defeat, even though it's actually the opposite. You have to be willing to cut a losing position quickly, without ego, without writing yourself a long explanation for why it'll surely come back eventually. The wealthy protect their capital first and chase returns second, and that order matters more than almost anything else. I'm going to tell you today more than any stock pick or any hot tip you'll ever hear. Most people do the exact opposite of this, and it's not because they're careless, it's because it's human nature. They let winners run scared, selling small gains too early because locking in a little profit feels good and safe. And then they hold on to losers far too long because selling feels like officially admitting they were wrong about something. I've watched brilliant, hardworking, genuinely smart people destroy years of gains in a matter of weeks because they simply couldn't let go of a position that was clearly broken and clearly telling them so. Here's the mindset shift you actually need to make. Being wrong isn't the problem. It happens to everyone, including me, more times than I'd like to admit. Staying wrong is the problem. The market doesn't care about your original thesis. It doesn't care how much research you did 6 months ago, and it certainly doesn't care that you were almost right or that it's due for a bounce. If the trade isn't working anymore and the reasons you originally bought it no longer apply, get out. Plain and simple. Take the small loss on purpose so that you never have to take the catastrophic one by accident later on. Before a downturn especially, go through your entire portfolio, every single position, and ask yourself, would I buy this today, right now, at this exact price, knowing everything I currently know? If the honest answer is no, that position is a liability quietly sitting in your account, not an investment working for you. The wealthy do this kind of ruthless house cleaning on a regular basis, not just when everything is already falling apart around them. They trim, they cut, they simplify, long before the storm actually arrives, so that when it does arrive, they're not scrambling around in a panic. They're already positioned exactly how they want to be. One more thing on this, because it's easy to miss. Cutting a loser isn't a punishment, and it isn't a failure. It's just information, the market handing you feedback, and the fastest way to make peace with that is to stop treating every sale as a verdict on your intelligence. Some of the wealthiest, most successful investors I've ever known are wrong on a huge share of their individual decisions. What sets them apart isn't some magical hit rate, it's that their losses stay small and controlled, while their winners are allowed to run and compound. Get that math right, and you barely need to be right more often than you're wrong. Fourth, and this one is a little more advanced, but I want you to at least understand the core idea behind it, because it's exactly what separates true professionals from everyone else scrolling through their phone during a crash. The wealthy don't just avoid the storm when it comes. Some of them actually position themselves to profit directly from it. This is essentially what people mean when they talk about hedging your portfolio. In simple, plain terms, a hedge is something you own that tends to go up in value when the rest of your portfolio is going down. Kind of like an insurance policy sitting quietly in the background. You hope you never really need it. But if the storm hits hard, it softens the blow considerably, and in some cases, it can even turn what would have been a painful, rough period into a genuinely profitable one instead. Now, I am not telling every single person watching this video to go learn complicated options strategies overnight. That can be genuinely risky if you don't fully understand what you're actually doing. And I would much rather you not lose real money trying to copy something you saw in a 10-minute video without proper understanding behind it. But there are simpler, more accessible versions of this same idea available to regular everyday investors. Certain assets have historically held their value, or in some cases even gained value, during periods when stock markets were falling apart around them, things that aren't tied directly to corporate earnings the same way regular stocks are. The wealthy typically keep a portion of their overall wealth, and I mean a reasonable portion, not the majority of what they own, parked in assets like this specifically to act as ballast so that when their stock portfolio takes a hit during a rough stretch, they're not feeling the full force of it all at once, and they're not being forced into desperate panic decisions at the absolute worst possible moment. The lesson here isn't go buy this one specific thing I happen to mention. The lesson is to understand the actual concept of holding something that tends to zig when everything else zags, and then figure out, based on your own careful research and your own honest risk tolerance, what version of that idea genuinely makes sense for your specific situation. Insurance you never had to use isn't wasted money sitting there doing nothing. It's often the exact reason you were able to sleep fine at night while other people around you were losing their minds. And that peace of mind matters more than people give it credit for. Panic makes you sell your best holdings at the worst possible time, right alongside your worst ones, just to make the pain stop. A portfolio built with some genuine ballast in it means you're never forced into that position in the first place. You get to make decisions from a place of calm instead of a place of fear. And in this business, that alone is worth more than almost any single stock pick you'll ever make. Fifth, and honestly, if you only remember one single thing from this entire video, remember this one, because it's the real difference between people who get rich from a downturn and people who get absolutely destroyed by one. The wealthy have their shopping list ready and waiting before the sale even starts. Think about how you actually shop in real life for a second. If your favorite store announced a massive, once-in-a-decade sale starting next month, you wouldn't wait until the actual day of the sale to figure out what you wanted to buy. You'd already know exactly what you're going in for. You'd walk in with a clear plan and a clear head. But when it comes to investing, most people do the complete opposite of this. Every single time, they wait for the crash to actually happen first. And then, right in the middle of all that fear and chaos and endless bad headlines, they try to figure out for the very first time what's actually worth buying. That is an almost impossible position to make good, clear decisions from, because fear is loud, it's overwhelming, and it drowns out clear thinking almost completely. The wealthy do their research now, during the calm, boring stretches, while nobody around them is panicking and everyone's mind is still clear and level-headed. They build a real specific list of businesses, funds, or assets they genuinely love to own at a lower price. They figure out roughly what price would make each one an obvious, exciting deal, and then they simply wait, patiently, with cash already sitting ready for the market to eventually hand it to them. When the downturn actually arrives, they're not scrambling around trying to figure out what to do on the fly. They're simply executing a plan they already carefully made months earlier. That's the entire difference. And it's a bigger difference than most people realize. It's not that they're inherently smarter than everyone else in the room during the crash itself. It's that they did all of their real thinking months earlier, back when it was easy and calm to think clearly, instead of trying to do it in the middle of the storm when panic is running the entire show. I'll tell you honestly, some of the best purchases of my entire career happened during periods when I felt almost embarrassed to be buying. When every headline was screaming that the world was ending, when friends thought I'd lost my mind, those moments felt terrible in the moment and looked brilliant a few years later. That's not a coincidence, and it's not luck either. It's simply what happens when you've already done the thinking ahead of time, so that fear doesn't get to make the decision for you when it actually counts. So here's what I genuinely want you to actually do. Starting today, not someday, not next month, today. Go look at your portfolio with completely fresh eyes and ask yourself honestly which positions you buy again right now at today's price and which ones you're just holding on to out of stubbornness or misplaced hope. Start paying real attention to what the central bank is actually doing with money and credit. Instead of just reading surface-level headlines about it after the fact, build yourself a real, specific shopping list of things you genuinely want to own if prices dropped hard, and figure out roughly what price on each one would make you truly excited to buy rather than nervous. And build up at least some meaningful cash on the side, not because you're scared of the market or trying to time it perfectly, but because you want to be the one holding the cards when everyone else around you is completely out of moves and out of options. This isn't about predicting the exact day everything turns, because nobody can genuinely do that with any real consistency. And anyone who confidently claims they can is almost certainly selling you something you don't need. This is about making absolutely sure that whenever it does happen, and it will happen eventually, it always does, you're one of the calm people quietly executing a plan instead of one of the panicked people selling everything at the very bottom out of pure fear. That's the entire difference between building real, lasting wealth over a lifetime and starting over completely every single time the market gets rough. Do the work now while it's boring, while it feels unnecessary, while nobody's watching or applauding you for it. That's genuinely the whole secret behind all of this. And now, whether you fully realize it yet or not, you actually have it. I've given you the exact framework it took me decades to fully understand, and I've handed it to you in 30 minutes. What you do with it from here is entirely up to you. Most people who watch a video like this will nod along, feel motivated for about an hour, and then go right back to doing nothing different. Don't be that person. Pick one thing from today, just one, and actually go do it this week. Whether that's building your first watch list or finally checking on how much cash you're really sitting on. Small, deliberate action beats a perfect plan. You never start. If this helps you see things a little differently, subscribe, share it with someone who needs to hear it, and I'll see you in the next one.